All right, we're going to get started. So thanks everyone for joining us tonight. We have a great, presentation today about how to maximize your wealth with infinite banking with our hosts, David White and Erica Neal, who we will kick them off and get them started shortly. And for those who don't know, my name is Tarek Musa. I'm with Disrupt Equity. We are operators coming up on about $600 million now in assets across 4,000 doors or so. So appreciate you guys making time tonight on this Wednesday evening to actually join us. So with that, if you give me a second, I will get Erica and David kicked off. Stand by just a moment.
And then Tarek, usually we do intros with the other co-hosts as well.
Okay, go ahead then, please.
Sounds good. So I'm Ronnie Phillip. I'm one of the co-hosts of this Texas Multifamily Masters virtual meetup. Thank you for everyone for joining. My company is the Kingly Group. We're a real estate private equity firm based in Dallas, Texas. We focus on acquiring value-add multifamily across the Sun Belt region. We've bought over 1,500 units across Texas, Georgia, and North Carolina, and really excited to discuss the infinite banking with David and Erica. I think it's a really good tool for investors to utilize. So I'll pass it over to John. If John's not on, I'll pass it to Anton.
Yes, hi everyone. Anton Madley, co-founder and CEO of Peak Financing. We arrange financing for commercial real estate property, and a lot of the properties we finance happen to be multifamily. And we help a lot of syndicators with their purchases. So we are very familiar with syndication structures, including text and so on. So I'm also a co-host of the Multifamily Masters Dallas chapter, together with Ronnie and John Montero. Not sure John doesn't look to be on. And so I will help moderating tonight's event. Ben Saddles and Ferris Musa, unfortunately, they cannot make it because they are at the corporate event tonight. But that doesn't really matter for you guys, because we have Erica Neal and David White with us, and that's why you all are here, and that's really what is important. And we're certainly looking forward to hear more about infinite banking, and hopefully you guys have a lot of questions. So Erica and David, please go ahead and introduce yourself.
Absolutely. Thanks so much. Like I said, my name's Erica Neal, my business partner, David White here. We are co-founders of Infinity Investment Strategies. So we are an infinite banking firm that works specifically with real estate investors and business owners on understanding the strategy, making sure that it is designed and put into place correctly. But even more importantly, once you understand the strategy, once you put it in place, it's a matter of how do you actually plug and play this into your overall financial portfolio. So because we are real estate investors and business owners ourselves, we work really well with other investors in helping them understand how do you use this alongside all the other aspects, all the other assets that you have in your overall financial picture. So this isn't something, I always make the joke, I'm like, this isn't something where, we just set up a policy, smack your butt, you're out the door. Okay, thanks. This is something where we actually help create these systems and processes so that you can use this as an ongoing part of your overall financial picture. So I'll let David add anything if you wanted to.
Yeah. Thank you guys for having us. Ben and Ferris are good friends of ours. And of course, we've set up Ben and we're setting up Ferris. There's actually quite a few people that we service in this kind of multifamily scene. And we pride ourselves in being the go-to. Combined, we have 32 years of experience. I think we'll talk about that a little bit later in overall financial experience. I've done everything from brokerage to advanced derivatives trading to income planning. Eric and I both do a lot of real estate. We are active and passive syndicators. I have multiple short-term rentals. We've done new single family development, and we both have multiple policies that we deploy into real estate. So you'll see a lot of people out there teaching infinite banking. I think the one thing that I would suggest to ask them if you come across somebody is, hey, how are you using it? And are you specifically using it for business and real estate? Because we are. So we practice what we preach, and we're big advocate for the strategy and big believers for it. And this is coming from a guy that used to be a Wall Street guy that used to poo-poo insurance products. So, you know, that's kind of just shows where I've come from in understanding this utilization of this. So we're going to kick off a presentation. So I'm going to share my screen. Erica's going to start this presentation. It's going to be pretty high level. We're going to get in a little bit of detail, but we're going to kind of leave that carrot out there, kind of dangling, so that if you guys want more information, we can certainly work with you on a one-on-one basis so that we can actually talk about how this fits into your plan and kind of tailored aspect to this. So we'll have a Q&A at the end. So you feel free to type questions in the chat if you have questions that we can address towards the end of the presentation. So I will, if the host will allow screen sharing, I'll go ahead and share the presentation.
Which is a good point. This strategy, it's not difficult. It is a mind shift, right? We're gonna have to start looking and thinking through things in a different lens. We will help you along that process. This conversation is going to be very foundational. So just like real estate, right? We want to have a good solid foundation and build on top of that. Now, I don't know who knows what. I know we've got a couple of experts, Chris and Giancarlo, and a couple of infinite bankers here already. Renato, I see you too. Hi again. So a couple of people that are familiar with this and others that may have never heard of it. So we're going to start very foundationally. And then like David said, we can build upon this, begin the customization and the detail of getting into the nuts and bolts of this. As we set up, you know, different one-on-one calls with people who have additional questions. So we'll go ahead and jump into it because we want to be cognizant of time. So again, we are Infinity Investment Strategies. And when we're talking about the infinite banking concept, what we're saying is, all right, how do we stop giving our money to a traditional bank, allowing them to go out and earn interest and earn money on our dollars? We're going to recapture that and say, instead of putting it with a traditional bank, I'm going to create my own bank so that I can earn compound interest on my dollars, so that I can increase the volume of my money that I'm earning compound interest on. Compound interest is the eighth wonder of the world. We want to take max advantage of that, and these policies will allow us to do so. So we'll go ahead and move on. So the big thing here is you'll hear it called infinite banking, bank on yourself, be your own banker, right? We keep using this word bank over and over and over again. And the question is, why do we want to be a banker so badly? But when we understand how banks make money, we can see how they've become the most profitable industry in the entire world. Over pharmaceuticals, over oil and gas. These guys are raking it in. So what does that mean? And let's understand a little bit deeper, how do banks make money so we can recreate that process? So if you go to a bank and you deposit money inside of a bank, right? Well, most people look at this and think, well, if you're a banker, right? Because you're going to become your own banker, is your deposit a liability or an asset? Well, guess what? Most people think it's an asset, but if you are the banker, again, we're going to have this mind shift. That deposit becomes a liability. You owe that to whoever deposited the money. Now, until we put that to work, it's going to continue to be a liability. How do we turn it from being a liability? Well, we're going to put it to work. We're going to take it and we're going to lend it out. Now, when we lend it out to a borrower, that loan, is it an asset or a liability? It's an asset. So again, this is where we start to have the mind shift and start thinking like a banker, not like a consumer. Okay. If you're a consumer, your deposit might be your asset, but as a banker, that deposit's your liability and the loan is your asset. So whenever the banker wants to start putting that to work, they lend it out and it is an asset because why? That borrower is now going to be paying it back to the bank. So the borrower begins to pay back the bank at an interest rate. We're going to use 5.2, and I'll tell you why here in a minute. So 5.2% interest is what gets paid back to the bank. And then to settle up their liability, the bank is going to pay 0.2% to the depositor. Okay. Now, when we look at this, let's look at this as a practical example. Let's say that you go in and somebody deposits $10,000 with a bank. Okay. So a deposit of $10,000. Well, if I'm paying 0.2% to the depositor, that's costing me as a banker $20 on that $10,000. But when I lend that $10,000 out, because as soon as we deposit that money, the banks lend it out. That profit that they're earning is going to be about $520. Okay. So most people look at this and think, oh, well, it costs 20. They earned 520, so they made about 500 bucks, right? But again, this is where we start to have the mind shift. There is a difference between money and math. We are not going to think through the lens of math. We're going to think through the lens of money. So let's think about how a business actually runs. So if we're looking at how a business actually works, we're going to look at the profit. Oh, is that? I think somebody's not muted. So how a business actually works is we're going to take the profit divided by the actual cost and figure out what is our profit margin here. So the profit that was actually made, right? We made 520 bucks. It cost us $20 to do so. So let's take that 520 divided by 20, and that is a 26, right? 26 multiplier. Said another way, that is a 2,600% rate of return. Think of something that you could invest $20 in and have 520 by the end of the year. Well, what would happen if I said, well, you know what, maybe I want to change that 20, I want to change it to 40, I want to change it to 50. But the point is, the banks have figured out how to use OPM. They're using other people's money to go out and earn a rate of return. Now, in this entire transaction, here's the big, oh, I'm sorry. Why did I use 5.2 and 2%? The reason I'm using this example is this is not made up. This is not fake numbers. These are things that you can actually see on the Bauer report in 2016. These are the actual numbers that Bank of America reported. So again, these are not things that we're making up. This is actually happening. Bank of America, Wells Fargo, Chase, all of these guys are making this type of profit margin on our deposits. Okay, so who has the use and control of the dollars throughout this entire process? Who gets to use the money? Who gets to control the money? Who gets to earn the money? The bank does. The bank is in control. They get to use it and they get to make it all. So this is why we should become, and this is why we want to become our own banker. We want use and control of our dollars, and we want to be able to earn interest on our money ongoing. All right, so we'll move on. Now, here's the thing. David mentioned we come from the traditional financial planning space. I worked in like the pension and the retirement planning. He did the stockbroker side. But the point is, the financial world, I'm sure you guys know, is very much a my daddy can beat up your daddy space, right? Like everybody's better than the other guy. But the problem is that we have to understand, and what David and I really want to help people get to a point of is there is no such thing as a good tool or a bad tool. So what we want to look at is what tool are we using for which job, right? Because if you try to cut a piece of wood in half with a hammer, we can't get mad at the hammer and say, oh, this hammer sucks. No, you're using it wrong. It's not the right purpose. So we need to identify what are we doing and what tool serves what job. So for example, let's look at the short-term need, and that's obviously going to be our bank account. Why are most people putting money into a bank? Well, most of the time they consider it to be safe, right? That's a relative term, and liquid. We're going to pay bills on a day-to-day basis. The catch to this is, though, are we going to get any growth out of a bank account? No, that's fine. It is what it is. This is money we need to use within the next 12 months. Otherwise, we're losing money due to inflation, especially in this environment, right? Now, let's look at the long term. So on the long term, this box is our investment category. So this is anything over the next 5 to 10 years that we are planning on coming to fruition. It could be your stock portfolio, real estate. It could be your business, whatever, right? Something that's going to come to fruition. Now, why are most people putting money into this box? Well, ideally, we're hoping to get some level of growth. We can't guarantee it, but that's the plan. But we have to acknowledge that investments are not safe. There's no guarantee. And we know that investments are not liquid. Once I put my money in there, it's in there for a designated amount of time. So this is what we call the savings dilemma, right? If you want safety and liquidity, you have to sacrifice growth. And if you want growth, you have to sacrifice safety and liquidity. So now we have this gap here in the middle that we need to figure out, how do we fill in all of the holes that aren't being fulfilled at this point? We want to bridge the gap between our short-term needs and our long-term investments and do everything that's not being done. So what does that mean? A couple of options. Well, one, we want to give ourselves guaranteed growth. And I'm talking a lot more than what we're getting in a bank. Okay, so we're going to have guaranteed growth. We also want our money to be safe. So when I go get it, I know that it's there. I don't have to worry about market volatility or any of that. It needs to be liquid and accessible. So being able to get it without jumping through hoops. Now let's also add a level of privacy and tax-free, right? We're going to hone in on here in a minute. It's tax-free and completely private. So in fact, if you notice, the vault here, that terminology is actually coined by Warren Buffett. So think of a vault or garage in your basement or, whatever. So if you have a vault, you can put money in when you want, and you can take money out when you want. And who knows how much cash you have sitting in your vault at home? Just you. That's it. Nobody else's business. So you have control over it. It's safe, it's protected, and it's completely private. Now, here's the question. Well, we have all these different assets. We have all these different tools. So this is like having a hammer, a saw, and a screwdriver, right? They all do very different things. So how do we make these things work synergistically? Good question. I'm glad you asked. So here's what we're going to do. We're going to take money out of the bank and we're going to put it into the vault. We're going to fund the policy to build up the cash value. And then we're going to use that cash to invest in whatever you want. That cash is going to grow. And again.
There we go. You came
So
back.
there we go. So those investments are going to pay back into the policy vault. Now, with us earning more and continuing to grow and expand our business, that's extra money that's going into our bank account. Well, now we have a problem because we have too much money in our bank account. So we need to rinse and repeat this process over and over, where I put more money into my vault so I can do more investing and rinse and repeat the cycle. So obviously there's some subliminal messaging here. That is what David and I do. We help people create these infinite cash flow systems, right? Robert Kiyosaki talks about the velocity of money. I like to call that the flow and grow, where we are consistently allowing our money to grow and save and compound on a regular basis and flow between all the different assets that we have. So as we move on, when we're plugging infinite banking into our overall.
Uh-oh, we lose her again.
Yeah, looks that way.
She's
We're gonna help you
in Burleson.
understand. What's that?
Yeah,
Did you're in
yeah,
Burleson? We'll forgive you. You got Burleson internet.
Oh my gosh. Okay. So there are 4 things that we're going to look at here to make sure that we understand, right, what role is infinite banking actually going to play in our overall picture. So we've got lower taxes, increased leverage, increased control, and lower risk. So let's look at these one by one. So go ahead and move on. All right. So lower taxes. Self-directed IRAs, again, there's no good or bad tool. These are just a couple of things that we've had people bring to our attention when we're working with them on some hurdles that they've had when they're investing with an IRA. So what we're looking at on the IBC side is how do we solve the problems that are being created over here on the left-hand side? So infinite banking, when you invest with an infinite banking policy, the first thing to note is you absolutely get to use any and all depreciation that's available. You get to use any bonus depreciation that's left, right? You got a couple more months to do that. Bonus depreciation, cost segregation. If you have a business and you're buying, vehicles or equipment or a lease, whatever, you get to depreciate 100% of what's available. The next thing that you'll see on here, there are additional deductions that you will get to take on your taxes today, because when you're borrowing against your policy and you're using those loans, there is a simple interest. We're going to look at that here in a minute. There is a simple interest rate attached to that. And that interest, you get to write that off today as an additional deduction. Now, as your cash continues to grow and earn and compound, you have the ability to use your cash value and the growth within your policy. All of it, you get to use completely tax-free through the loan strategy that we'll look at. So you're using all your money and the growth tax-free. Now, we all get to a point where we may not retire. That's kind of a funny word, but we'll get to a point where maybe I don't want to work as hard. I just want to sit on the beach and drink margaritas, right? Or drink of choice, right? So the point is, all of the assets and everything that we are building up in our personal portfolios today is building up these cash flow assets. These IBC policies are no different. This will become one more cash flow asset, one more cash flow arrow in your quiver. So when you get ready, you can say, hey, David and Erica, I don't want to put any more money into this. I want to flip the switch and I want to start drawing and receiving income. And you will get a tax-free guaranteed stream of income from this policy for the rest of your life. Regardless of the market, regardless of the tax environment, you get that guaranteed tax-free stream of income. There is no UBIT taxation. And one thing that I didn't put on here, and it usually is on here, there's no UBIT, so you don't have to file with the IRS at all. But you also, any and all of what is left behind when you pass away, everything that is left behind gets passed along to the next generation completely tax-free, no inheritance, no estate, no wills, no probate. This is the most efficient way to transfer generational wealth. In fact, they wrote a book about it called What Would the Rockefellers Do? Right? And those guys probably know something about generational wealth. But the point of this is, oh, there it is. So it's a tax-free transfer of wealth. So the point of this is we want to have tax benefits up front, but we also want to be tax efficient on the back end as well, so we don't cut our nose off to spite our face. All right, go ahead and move on. Now, control, if we're honest, I think all of us have some control issues. It's okay, right? Like, that's why we're here. We want to take control of our time. We want to take control of our money. So one of the biggest questions we get is, Erica, how easy is it to get to this money? Here's the thing. You get to borrow and lend on your terms. You are now the banker, so you make the rules. So when you take out a loan, you get to dictate at what pace you pay that back. So there's a couple of examples of this, but the biggest one is we had a developer that was building at a neighborhood. He planned on it taking about a year and a half or so. This project ended up taking over 2 years. It was almost 3 years down the line that this project finally finished out. He did not make a single policy loan payment the entire time. He was able to leverage his cash, finish out his project. He finished his project out all at once, paid it off, and then guess what? He just rinsed and repeated the process and went into the next deal. The entire time, he never missed out on losing interest. You also have access to your total cash value. I emphasize this because there are policies out there that have vesting periods or surrender charges or whatever. We don't play games with that. Whatever your cash value is, that's what you have access to, okay? You also get to use whatever your cash value is. You get to use that to count towards 100% of it goes towards your liquidity or net worth on your PFS. So if you want to be a passive or a KP or a GP, you get to include this policy cash value on your PFS. You get true diversification, meaning you're not subject to any market fluctuations. They're guaranteed. You have flexible savings. We're going to hone in on that here in a little bit. You get to dictate, right, how much you put in and when. You have complete control over that. And then at the end of the day, when you are doing your business plan, whether it's 5, 10, 20, there's some young people here, it might be 40 years down the line. These policies are incredibly reliable with their projection. I'm a natural skeptic. I know David's the same way. I actually pulled the dividend history for one of the companies that we use. A lot of them, all of them are like this that we use, but we pulled the dividend history to see, all right, how accurate are they in predicting what they're actually going to pay out? And for I just looked at the last 50 years. For the last 50 years, they have either met or exceeded their projected dividend every single year, except for 2. In the 2 years they missed it by 0.5%. So the point to that is when we start to look at numbers and we start to show people what their plans and what their policy designs are, we're not just throwing stuff at the wall to see what sticks. We are showing people true bank ledgers that you will be able to put your business plan in place and know exactly what to expect. Now, lower risk. The first thing, I love this part, business is great, real estate is great, it's awesome, but we have to acknowledge there are what we call wealth eroding factors. The first thing to consider, obviously, those are market crashes. This is a big talk of the town right now, but these policies are uncorrelated. They're guaranteed to grow every year. So what does that mean? If the market goes up, your IBC policy goes up. If the market goes down, guess what? Your IBC policy still goes up. So think about that, right? When does most buying opportunity present itself? When the market's down, right? So if you have your liquidity tied to the market and it goes down, you would have to lock in losses to take advantage of that buying opportunity. So these policies allow you to be in a buying position all the time, regardless of what the market and the economy is doing. The next piece we have is creditors and the IRS. So it could be a bank, it could be IRS. If you have a financial hardship, or if they want to put a tax lien, God forbid you make an accounting mistake, right? We have plenty of new IRS agents that are going to find those. So if they come in and they want to put a lien, or if they want to come seize assets or freeze everything, anybody who's dealt with the IRS knows they do not pull their punches. So these creditors, anybody that you owe money to, or the IRS, they do not have access to, and the cash value inside of your policy is protected from being touched by creditors who are coming after you or the IRS. The one thing I'll say on that is depending on the state you're in, the limits of protection can vary. For example, we're in Texas and we get 100% protection of the cash value. Again, we can talk on that one-on-one, but the point is most states are going to have close to 100% protection of the cash value. Now, a run on the banks. So again, this is just an area of, are we going to be able to access our liquidity if we need it? So we know banks have little to no reserves, right? And banks get to tighten up and loosen up on credit expansion when they want to. I can probably count multiple people here who have dealt with trying to close on a deal and the lender changing their LTV at the very last minute, right? They get to pick and choose what they want. We had a guy in North Carolina who owned 120 units outright, and he wanted, right, and COVID hit, he needed access to cash to put into his property during that time. Well, he had over $1 million in equity in his primary residence. He went to the bank to get a HELOC to use that money to put into his property. He did not syndicate it. He just owned it outright. And the bank told him no, wouldn't do it. So do we really own something if we have to ask somebody else permission to use it? So that's just kind of the point, right? Like if we have equity in our home, or if we have, right, all these other assets, if we can't get to it, it doesn't matter. And then the last part of this is predators. Okay. So again, we're in a sue happy world, right? Like it is what it is. We all know that. So this could be a disgruntled investor. It could be a clumsy tenant. It could be, you know, a bad boy rule. Not that anybody here would ever do that. But the point is LLCs can be broken through. They're a great barrier to have, but they are capable of being, you know, penetrated. Now, the last one is a car wreck. So this is just an example of, it could be something completely outside of business. I live in DFW. The traffic here is a nightmare. So if I'm driving and I rear end somebody and they get out and their neck hurts a little bit too much, they can come after me for my house, my car, my dog, whatever. They can sue me for anything and everything I have, but they cannot touch the money that I have inside of my policy. So the point is here, all these different, what we call wealth eroding factors, all these different risk elements, we want to have as many barriers of protection for ourselves, for our family, and for our assets. And these policies create another barrier to protect all of those. Now, let's talk about this leverage piece. So we're going to go through this on a high level scenario, just so you understand why people are borrowing from their policy. Now, if you have an IRA or a basic bank account and you have $100,000 in there, let's say that you take out $70,000 as a loan. Okay. When you take out that $70,000 as a loan, well, now you're only earning interest on the $30,000 left over. Pretty standard. But if you have become your own banker, you have $100,000, but when you take out that loan, you borrow against your policy, and you're going to borrow that $70,000 to go out and invest in whatever you want, multifamily, single family, vehicles. You can buy Bitcoin for all we care. It doesn't matter. But the point is here, you're going to have that simple interest rate that's attached to the loan, just like remember what the bank did, right? They had a little bit of an interest that they paid to the depositor, but then they're going to borrow and they're going to turn that into an asset. So all of these assets that you have outside of the policy, that is what's earning your rate of return. Your multifamily, your single family, all the real estate, all the different investments that you have is out there earning you a rate of return and becoming your asset. The cash flow you receive from those investments goes back into your policy. The big difference is the entire time that your 70 was out there working and out there invested, you still continue to earn compounded interest on the full 100,000 cash value amount. So this is where we're starting to see you can use your money to go, you can use dollars to go out and invest while you continue to earn compound interest and never, ever miss out on a day of interest. Okay. So here's the thing with these policies. Again, we are using a specially designed cash value life policy. That's what it is. But what we'll look at is these are going to be very different than what you can get if you walk down to your State Farm agent. Okay. We are using A-rated and mutually owned companies. We're not messing with B- or any of those guys. So mutually owned means not me, not you. Nobody can go buy stock in these guys. All right. It is owned collectively by the policy holders. Okay. Now, how does this work? You have this baseline at the bottom, that guaranteed base premium. Whatever you want your minimum to be, that minimum is locked in. They can never, ever increase it. It is guaranteed to remain level. You have your death benefit, this red line here. So that death benefit is guaranteed to increase over time. It's what we call inflation adjusted. So that guaranteed death benefit is going to increase and increase and increase over time. Now, just like any other asset you have, it begins to build up cash or equity. So this green line here shows you have a guaranteed cash value that is going to grow exponentially over time. So it's guaranteed to grow, again, regardless of what the market's doing. Now, again, I mentioned it's mutually owned. There are no stockholders that can participate here. So who do you think the company pays dividends to? The policyholder, because again, you're a part owner of the company. So these dividends get paid to you. They get reinvested back into the policy and they make your cash value grow even faster. Now we're going to throw an additional element in here. So this green line here represents what we call paid up additions. This is additional cash saying, hey, if I want to put extra cash in here, if I want to make this thing grow faster, if I want to, David uses the analogy of rocket fuel. If I want to supercharge this thing and make my cash value grow faster, you have the ability to do that and add it on top of everything else. Now, the key here is all of that is growing and earning and compounding inside of your policy, you have access to the full cash value amount, whether it's your guaranteed, your dividend, or the cash you put in, whatever is there, you have immediate access to. So at this point, this is where we want to start to understand, okay, we know more about the infinite banking strategy. I'm going to hand it over to David. He's going to talk a little bit more about, all right, how do we actually structure these policies so that they are designed for max efficiency on the infinite banking side?
Yeah, thank you, Erica. Good stuff. So, banking, man, how do we emulate that? Well, we understand the strategy and how to utilize it, but how do we actually design this? So we have to understand a little bit more. And again, we're going to stay high level, but I want to try to kind of gauge a little bit of the scope of insurance products so that you guys can begin to understand the design, so that when we meet on a one-on-one, you'll start to at least have a baseline of understanding of what we're trying to do with these assets. So you kind of have a spectrum of efficiency when it comes to cash, because we're going to focus on cash value. Obviously, there's a death benefit component to that, which different people have different needs for death benefit, but we really want to hone in on the cash portion. So you have kind of a least efficient, which that is term life insurance, right? Term life insurance, basically for every dollar in, it has zero cash. It just purchases death benefit, right? And it expires. So it's purely all cost for death benefit coverage, okay? And then on the most efficient, you have a single pay policy, which is $1 in is $1 in cash, right? Which equals about $1 death benefit, maybe a little over, depending on your age and your health and all of that, okay? That is a single pay policy, okay? And that is something actually that a lot of brokers back in the 80s sold way more of these single pay products than insurance agents ever dreamed of, right? Because they were tax efficient, right? But in 1988, something happened. The government got wind of this and they said, wait a minute, this is too much money to be stuffing into an account that functions like a tax advantage or a tax invisible account. So they actually created a MEC line, okay? And what that MEC stands for is a modified endowment contract. So everything above the MEC line to the most efficient, anything put in that much is going to be taxed as a qualified account. So it's going to be a taxable account, okay? So we've kind of got a whole life, which just a standard whole life is kind of right in the middle, give or take, right? Where it has a death benefit and then it has cash value, but it takes time to develop cash value, okay? So on this most spectrum here, that is that kind of paid up policy, right? So you kind of have these paid up additions. Well, the way that the paid up additions work for that policy, right, was kind of all in and all there. Well, if we do that, which we can still do that, and it has its purpose in some estate planning scenarios, that still has its purpose. But if we want to keep the tax advantage in the account, we have to be careful in how we fund these. So we want to make use of the whole life, but we also want to make use of the paid up. Well, the way that infinite banking works is it takes that paid up, but it's attached as a rider to the policy. Okay, so we have this kind of baseline, and then we have that paid up additions rider, which is the ability to fund additional cash into the policy up to the MEC line. Now, without getting into any specifics, which we would get into on design, without putting any term riders on it or any additional kind of cheap insurance to get more cash in, it's usually about a 40 to 60% split, meaning let's just use 100,000, right? We have people putting in less than 100,000. We have people putting in 7 figures into these policies, right? But 100,000 is easy math. 40,000 would be a whole life premium and 60,000 would be in cash. Now, again, there's ways to design this, maybe 70-30 split, maybe 80-20 split. Again, when we meet one-on-one, we can go over those illustrations, the pros and cons between the two, and kind of dive into that a little bit more. But just on a pure paid up additions rider with no additional term insurance, it's a 40-60 split, okay? And that 60 is going right into cash day one, okay? So really what I want you to take from this is just, there's a lot of flexibility on how we set this up, okay? Based on somebody's finite budget, we can set it up to where there is a minimum and there is a maximum based on what the IRS will allow. Now that maximum, right, that is optional. So you can put anything from the minimum up to the maximum and anything in between, okay? And there is some other stipulations about backfilling a couple of years and all of that. Again, we can get into more specifics. Just the key that I want to highlight here is that it's a lot of flexibility on how we fund this based on ebb and cash flows and different types of scenarios and getting in and out of investments, okay? Now, specially designed life insurance. So kind of looking at those PUAs. Okay. So what we're doing is we're taking somebody's budget, again, looking at 100,000, could be 10, could be $1 million, right? Some people have more zeros than others, right? It's not about the dollar. It's about whatever finite budget you have. How do we design this in a way to be as efficient as possible? Because one thing I meant to say earlier is if the IRS, think about this, if the IRS is saying, okay, you used to be able to do all of this, right? But we're going to cap it. Okay, well, why did they cap it? Well, because they're limiting tax benefits. So now if we have the ability to do something, but have a cap on it, right? We're going to want to do that amount, right? Because that's the IRS saying, hey, you can do that, but only that amount, right? So we're going to want to take as much advantage of those IRS giving us those tax benefits as possible. But again, we're not married to them. But let's look at this 100,000, okay? We're going to split the PUA, the base between or split that 100,000 between base and PUAs, okay? So it's a little different than traditional life insurance. A lot of traditional life insurance doesn't factor in this MEC limit, the additional funding, and kind of these designs, okay? And we'll get into a little bit more specific on why we're really overfunding for 4 years. And then after year 4, we're dropping down to just the minimum because of the policy earning, okay? You're really getting dollar for dollar on that 60,000. By year 5, that 40,000 is actually earning more, so it's getting a multiplier. So Nash talks about opening up multiple accounts. So again, we can look at that more specifically on why we do that when we look on a one-on-one basis. But when we're splitting this, okay, so we've got this kind of 40 base and 60 PUA. Again, could be a different split. We can get more out of it. I know there's a lot of YouTube videos talking about 90-10s and 80-20s and all that. There's some pros and cons, okay? But just pure whole life with no additional term, it's a 40-60 split that we can get without making the policy, okay? 60,000 is going right in those years, dollar for dollar, and beginning to earn interest right away, okay? Now, year 1 has a lot of insurance costs, right? The insurance company can't say, here's a big death benefit. Oh, you gave me 100,000. Well, here, sure, take 100,000, go do what you want with it. Then you pass away, right? And you got all the money and they paying you a death benefit. How would they be profitable? So they have to actuarially recoup up front. So year 1, you're really not getting any of that 40. Now, year 2, you might get 35 of that 40. Year 3, you might get, another 35. Year 4, now you're getting, there's kind of an anomaly there. Year 4, you're actually getting dollar for dollar of your base and your PUAs. Then in year 5, year 40 might be earning 48, 49. You're starting to recoup that. So why would you put in dollar for dollar if you could get more of a base? So again, that kind of goes into that aspect of stacking policies. But what's happening though is because we're doing kind of front loading this and putting the cash in right off the bat, we have money to go and invest. So without this kind of growth lag that traditional life insurance has, right? You've heard people say, oh man, life insurance, whole life, I can't do anything with it for years, right? That's kind of that growth lag that comes with traditional life insurance. Well, with this, we're immediately able to now go and leverage that cash, borrow that 60, go get 80% LTV or used to, right? LTV on a property, let it cash flow 5%, but then that's actually cash flow return of 25% if you do the math. Again, I'll just kind of dangle that out there. You can figure that out yourself. We can go through the numbers, but on that 60, go and invest in a $300,000 property that's cash flowing 5%, right? That's 15% of your 60 or 25% of your 60,000, right? So the point is that you're actually out there now leveraging that 60 to go start buying assets. Cash flow is coming back in, future money's coming back in, right? And it's kind of this rinse repeat, all the while the money in the policy is beginning to earn. So what's going to happen is you see this kind of thing happen to where now the assets that you're accumulating outside actually begins to start to pay for the policy. But the point is here is you're setting this up in a way to where you're making it centered around cash value so that you can immediately go and utilize the cash to go invest in real estate, other investments, your business, right? That's an investment, and put it to work right away. So you're actually overcoming the insurance cost a lot faster by giving it that rocket fuel or front loading of cash, okay? So let's go back to this kind of banking system, and we got a couple more slides and we'll finish up for question. So banking, right? We want to emulate banks. Well, why do we want to emulate banks? Well, man, you saw that slide, right? How they actually leverage your money. It amazes me, right? How did we get to a point? If you think about two companies, right? ABC and XYZ, ABC deposits money in a bank, loans it out to XYZ and vice versa, right? And what happens is all they're doing is taking one company or money from one company and lending it to another, but they have liens on all of the properties and the line, have all the terms on the lines of credit. So who takes all the risk? The companies take all the risk and do all the work. But if something fails, the only secured creditor is the bank. Right? How do we get in this? How do we get in this scenario where the bank wins 100% of the time if the companies fail, but yet we're doing all the work and all the risk, right? That's another conversation for another day. But how do we actually divert some of that cash flow? Because when I realize that the bank's making that much money on my money, man, how do I stop giving money to the bank, right? And that's exactly my attitude. I keep as little money as possible into the bank, and I put as much money as I can into my bank, okay? And the reason is I want that control. So you've got this policy, right, that you're setting up and you're making it around cash value, and that cash value is going up. And you've kind of created like a bank-owned life insurance, a corporate-owned life insurance. What banks and corporates have life insurance? Absolutely. And they center them around cash. In fact, I could show you reports that in 2020, there were basically banks that had 53% of their total liquid assets in these BOLI-COLI assets, right? And you also have this kind of death benefit aspect, and you have this illness protection, right? So you kind of have all these facets of this policy, and we're using mutually owned insurance companies, right? Because again, the bank, right? They're kind of the owner of that whole scenario. And we're not talking about the bank president that you go play golf with. We're talking about the owner of the bank, right? So the mutually owned company, right? We are mutual owners of that company. So we actually own our policy, right? So we actually have contractual guarantee. It's a unilateral contract that we can take loans against our cash at interest only if we want to. And that loan can trickle down to you, the banker, right? And they just put liens on your cash value. So you're actually, right, using OPM. So you are in complete control. What did the bank do? Took my money and was in complete control of my money, right? And was able to lend it out. So now I'm in complete control of this policy, and I can use the insurance company's money and have dictate what I use it for and the terms in which I pay that back. So what am I going to do? I'm going to go put it into an asset. Now, some of you guys might be looking at, well, why is the asset on the right side? Okay, well, because this is backwards. Just like the bank, the asset is when we loan it back out. So it's flipped. You have to be thinking on the other side of the ledger. Okay, so we're going to use the example of real estate, right? Because that's what we all invest in here. So we're going to go and we're going to bank on and we're going to invest in real estate. And that's going to create a cash flow that we're going to cash flow back to our bank. And we're going to kind of rinse and repeat. Now, the difference between wealthy people and poor people is that wealthy people have cash flow that cash flows towards them, right? Poor people have cash flow that cash flow away from them, right? So we want to create this kind of system that is building assets through our leverage of OPM and using traditional leverage, right? We're not completely getting rid of banks to leverage. We're just warehousing our dollars to utilize it as a banking system, right? Now, any dollar that we pay above the principal, or I'm sorry, above the interest is principal. right? And that is basically going to come from the lien of the cash and go back to cash value, increasing our net cash value, as well as the growth of our cash value is all increasing our net cash value. And we're just going to rinse and repeat this from the growth of our policy, from additional money. We are going to now rinse and repeat into multiple assets. So you got to think about this. What's happening here? Normally, you have to have one or the other, right? You have to have this one account over here that's earning and the assets over here. But this is the and asset. You have the policy growing, uncorrelated loan, and you have the money using in assets outside. There's a book called The And Asset, right? It completely talks about this because it's not an either or, it's an and. This is why this can be such a plug and play system, right? So we got to think about what's happening here though. And we have to kind of get this rate of return out the window, even though it's very important to look at and structurally, but we're not so concerned about the minute details of the policy because we got to look at exactly what's happening here, right? We have a rate of return in the real estate assets that we are investing in through appreciation in the assets. We also have a rate of cash flow from those properties, right? We also have a rate of return that's inside the policy, right? We also have a tax invisible account here, okay? That means that, yes, there are ways to pull money from this lifetime tax-free, right? And the one thing I'll ask is, what will tax be in 20 years? What will tax brackets be? What will real estate tax be? Will capital gains tax be through the roof? Will we still have cost segregation and bonus depreciation? Hopefully we do. Hopefully we still have tax favored accounts, right? But we have this kind of protection, legacy, tax invisible account here that gives us a kind of source of tax-free income that's earning a rate of return, our cash flow, right? And all the while, not only do we have all this benefit, but we also get to take, I'm not your tax advisor, right? But if you're investing in real estate, that interest that's being charged from you is another tax deduction. So not only are you able to take advantage of all of the tax benefits that real estate offers, because that loan is same as cash, it's looked at same as cash, you also get to take that tax deduction. Now, where does that come into play? I personally experienced the true benefit of that this year. So the only thing, my investing into investments for cost segregation, even investing in multiple RV parks that gave me 110% cost seg, did not pull me from the top tax bracket. I was so close. You know what did it? The infinite banking loans that I had, the interest that I had from my loans throughout the year, I was able to write off. That's what ticked me under. So just those loans right there was a massive tax benefit for me because it's what pushed me out of that big bracket this year. So it's a huge deal. So I'll kind of end there. Again, that's a lot to we wanted to stay conceptually, but there's a lot more to it when we get into kind of, okay, how does this actually work on the funding levels and how does it grow? But I do want to end here, right? A lot of people will come to me and say, well, not as much as they used to, but they'll say, hey, David, if this is so great, why isn't everybody doing this? And you know what I would say to them? Well, who's your everybody? Right? Is it Joe Schmo down the street who's got a subscription to Forbes magazine, right? Who's like, ooh, whole life? That guy's going to end up being on the Dow Bar report where net fees and taxes, he's going to earn 3.5% in his 401k, right? He doesn't know. Or is it people that are actually doing it? Right. And the more that you guys and gals hear of syndicators and talk and kind of really get into these wealth strategies, you're going to hear a lot of people utilizing this. So we'll finish up here, right? These are just a few examples. This picture on the left is Rockefeller Center, right? The book, What the Rockefellers Would Do. Amazing book. They talk about cash flow banking. I suggest read it. It also talks about generational wealth transfer and building this kind of generational wealth transfer through family banks, using death benefits to create family banks, avoiding a lot of tax through wealth transfer, and then leveraging cash flow banking. This building in the Great Depression, they would not give J.D. Rockefeller leverage. The banks would not. They wouldn't even give him leverage. Well, he fully funded the construction of that building through his cash value policy, right? It's crazy. Walt Disney, to open up the theme park, a banker turned down the loan for him to open up Disney, right? I'd hate to be that banker that turned down Walt Disney to open up Disney World, right? But he used the cash value in his policy to start the park, right? Pampered Chef, right? Pampered Chef basically could not get a loan in the early 80s. She utilized her cash value to start it. She ended up basically selling this for like I don't know what the numbers were. Erica, I think, has it, but it's
She
like,
took $5,000 from her policy, started Pampered Chef, sold it to Berkshire Hathaway in 2016 for 1.6 billion. So
results not guaranteed, right?
results not
You know,
guaranteed.
hey, that's insane. But she did it, right? From her policy, she had that leverage. Foster Farms, right? You know, you've got Donald Trump and Biden both have multiple policies that they fund their campaigns, right? And Erica's joke, and I love this, is, hey, if Democrats and Republicans can agree on something, that has to be good, right? Another point I'll point out is, right, if these politicians are utilizing it, and we have all of these kind of benefits around it, it's almost safe to say that there won't be regulations changing these. And if they do, it's only for future policies, not what we lock in. Now, last thing I'll say, and we'll finish up here, JCPenney's, this is a different kind of leverage. And this should be something that you guys should start to kind of think about too, okay? Because it's all fun and games until it's not, right? Until something bad happens. Well, JCPenney's in the Great Depression, nobody was buying retail. They were in trouble of going out of business. Okay. They could not pay their employees. Well, they used their corporate owned life insurance as leverage. They did an infinite banking to basically, because they thought, okay, if we can get through this storm, right? So they borrowed against their policies to pay their employees through that time. Okay. While their policies unaffected from the Great Depression, those policies were still earning. These policies earned. Great Depression, Great Recession, they earned uncorrelated to those economic downturns. So they were still kind of having that growth, but having a loan. Okay, when retail picked back up and the economies picked back up, they were able to cash flow themselves back. So they were able to sustain themselves through that. I know syndication teams that have used this strategy, and that I've helped use this strategy to create kind of a business banking account that they leverage as key man insurance with each other, and they store liquidity there. And they used it during the liquidity crisis times of like COVID and 2020, 2021 to actually cash flow investors. And when they got these programs and got some of these things back, they were able to cash flow that bank back, all the while that bank itself was still earning, right? Uncorrelated to that. So just the ability to kind of leverage through hard times is another kind of dynamic shift that we have to kind of think about, another piece of protection, right? So there's many different facets of how you can utilize this strategy. So I would suggest looking up Bully Coley. It's amazing. You go into a Wells, go do this. It's just funny, right? Go in, if you got some time one day, go into Wells Fargo and talk to their financial advisor, okay? And sit down and say, hey, well, what about life insurance, right? I guarantee you he's going to say, hey, buy term and invest the difference, man. So, you know, right? That's what they all say. That's the clue. But then if you look at Wells Fargo's balance sheet, well, wait a minute. Wells Fargo has 53% of its holdings in a bank-owned whole life insurance cash value policy. So why are you telling me to do something than what your company is actually doing itself, right? Anyways, have some fun with that. So why do investors choose us? And we'll end here, okay? Like I said in the beginning, we have 32 years of combined traditional financial experience. We have real estate experience. So we have a lot of plethora of knowledge that we combine with this. We're on an independent platform, so we're brokers. We don't work for company A and push company A's product. We pit different companies against each other to get the best policy design, best rating, all within the wheelhouse of companies that this actually works for. We are real estate and business owners ourselves, so that's our clientele. We're real estate investors, right, as I just told you. We are also authorized practitioners. This is important, I think, because, you know, there needs to be a unified teaching and understanding on infinite banking concepts, because you got a lot of Joe Schmoes out there schlepping insurance products all on the pretense that you can borrow against the policy, but not designing these in an efficient way. They've got, some of them might not mean to, but some of them have commission breath, right, out there selling these large policies on that pretense. So infinite banking, the program actually keeps track of our licenses, keeps track of all of our policies that we create. They have access to every single policy that we write with certain companies, because if we design one that's not efficient, they can kick us from the program, because they're very, very strict on unifying this concept, all based on kind of Nelson Nash's teachings and the infinite banking concept on doing this very specific on how these are designed. So we want you to work with us, right? But if you work with somebody else, make sure that they are an actual infinite banking practitioner. So we'll end here and we'll give it some time for questions. I will put up here, we do have our emails that you can email us, our phone numbers. If you want to jot those down, you can reach out to us and we can set a one-on-one to kind of dive into this a little further. I do see that we have some questions here. Let's see.
The first one
Yeah, I'll let you do
is
that.
it's pretty common. B Dweek, and the question was, can my LLC pay for my policy and take that as a business expense? And that's, I mean, I can't tell you how many times we've heard that. So the short answer is you can. However, you don't want to do that, because if your company pays for your policy, okay, and you write off that premium, you use that tax benefit up front, you lose the tax benefits on the back end. So that kind of is where, like David mentioned, it becomes a qualified plan. So then it turns into, right, like a 401k or a traditional IRA. We lose all those tax benefits on the back end. So keep in mind, though, that the interest from the loan when you're borrowing against your policy, that gets to be written off as a tax deduction. But you'll want to use post-tax dollars up front so you can get all the tax benefits on the back end.
Oh yeah,
Really
way
good
more
question.
tax benefits on the back end. Way
Oh,
more.
yeah. And what is the process? Oh, John. Hi, John. I'm glad you made it. What is the process to take a loan from the policy, and how long does it take to get a loan funded? The process to get let me say this, once the policy is already active, it's pretty quick. It's a matter of a few business days, a week tops, to be able to say, hey, insurance company, send me some money. If you do just a traditional, say, hey, they'll send it to you, they'll give you an ACH, it'll take a week tops. If you need the money overnight, though, David and I have actually called companies and pulled some strings and said, hey, we need to wire this money. We need it within the next 24 hours. So we have ways to expedite that if needed. The longest part of a policy to get a loan is if you were just getting started. So getting it started, again, takes a few weeks. But once your policy is already active, if you want to go in and get cash, I mean, you can have it sent to you via ACH within a week. And a lot of times it's sooner that. I'm saying a week on the long end, just to, account for any hiccups that may come. And, oh, David Hudgens asked, how do you hold the policy? Would it be held in a revocable trust? So David, do you want to answer that? Because I know you talk about trust a lot.
Yeah, absolutely. So yes, the owner and payer can be different things, and the beneficiary can be the different things. The insured is the only one that stays the same. Yes, there are some ways that the trust can own it. The trust can be beneficiary, it can be payer, you can have different things. There are some advanced solutions with ILETs, which are basically insurance type trusts that are specifically built to function for the trust. So yes, they can be very as simple as it's just the owner and the payer and the beneficiary, or vice versa, or there are some advanced tactics utilizing trust as well, which we can certainly go into based on kind of your needs for that. But yes, a lot of options there.
Definite benefits to that. Komivi asked, how do you get paid and how much? So just give us all your money. I'm just kidding. So that's a good question. So whenever we go through the policy design with each person, all of the costs are baked in already. So what you see on paper is what is already taken out up front as part of, David mentioned in year one, that acquisition cost by the company. Well, they are covering their costs, which includes all their internal costs, all their administrative costs. They pay us. So because we're independent brokers, we get to, again, we pick companies up against one another. We pick and choose. Once we bring business to that company, they reimburse us directly. So you're not going to get an invoice from us. You're not going to have to write a check.
Yeah, it's kind of like a broker, right? Who's selling your property. They've got broker fees on there that are part of the cost of you buying a property. Same thing. It's just baked into the cost. It's just line item there. You won't see a line item. It's just baked into the cost. But yeah, we're brokers. They pay us for bringing them business.
Giancarlo asked about whole life versus IUL. And David, I'll let you talk because you do a really good job of this, but I also want to point out, we just had a conversation today. I know you know who I'm talking about. We just had a conversation with a guy today who has had an IUL And he called us because he's through the roof, frustrated and angry. But David, I'll let you take that one.
Okay, no bad financial tools. No, IUL is not a bad tool.
No.
What is it for? It's probably for a company or somebody that's utilizing it that wants to maybe use it as a key man insurance / buy-sell agreement, and they want to leverage some cash flow, seasonal cash flow in there, and maybe take advantage of the indices. Okay. That's probably what it's for. For banking and lifetime kind of banking and income, you don't want to be tied to the indice, right? You don't want to have a policy that you are now loaning out to go and earn, and you have a cost of that loan, and then it's tied to an indice that tanked, and so it earned nothing, right? So now all of a sudden, the cost of your loan is negatively impacting your investment outside. Okay. Yeah. Are you trying to get the 9s? Yeah, sure. But we're not trying to chase rate of return with insurance policies, right? So we want just that steady, like the Pete Rose. I call it the Pete Rose. Whole life is the Pete Rose of insurance products. It's not home runs, but it's not strikeouts, right? It's base hits. With IULs, you could have a home run, you could have a base hit, but you could have a strikeout, and that can affect your investing outside. One other key issue too is they have these things called target premiums. Whole life is level. That means that premium never goes up, meaning no new insurance costs reintroduced to it. Okay. These target premiums of these IULs, they have the right, and they say in the contracts and all the fine print, to increase those target premiums. And they usually do about age 70, 75. Okay. Well, that's a long time off. Well, what happens if age 70, 75, you're still cash flowing assets, or now you're using this asset as income, and now you have an insurance cost increase because you're older and less healthy, and it begins to become what we call a carnivorous policy. So now you're eating from the cash value and it's eating from the cash value, right? Now all of a sudden you're getting letters from the company that you got to put in another 10, 15,000. We've seen it happen. So again, not a bad tool, but not for a banking system that we want to utilize for a kind of a banking and a kind of a self-made pension if needed down the road. It's more for that kind of 10, 15 year time frame for other uses. So good question.
Yeah, so David, maybe you just can also mention what IUIL stands for, right? For the
yes. Okay. So yes,
I didn't think about that either. I'm sorry.
It's an indexed universal life. So instead of where whole life is not tied to an indice or tied to anything, it's based on actuarial science and mortality tables inside the policy, right? So it has nothing to do with outside volatility. Indexed universal life is IUL. It's basically tied to a certain indice. So the performance of that indice will dictate how the credit of the policy, how the policy is actually credited. So it can have maybe an up year, it could have an okay year, or it could have a down year where it's earned nothing. So it's affected by that. So you're adding some volatility. And that's another thing. If we want diversification, right, we want that one asset that's uncorrelated, all that. Our real estate stuff, everything we do outside, that's the volatility stuff, right? I wouldn't want my bank, right? If my bank, Wells Fargo, said, hey, we'll give you 5% interest on your bank, on your money, I'll say, yeah. But what if they said, well, it could be 5, it could be 7, but it could be 0, or it could be negative, right? Because that, if you had a loan out on your cash, it could negatively affect your investment. So I wouldn't want that. I want my banking account to be steady and consistently growing, uncorrelated to all that. So good question.
Oh yeah. Couple of Prasad basically already has it. So Prasad, you're already a banker. Good job. Basically, can we use the extra liquidity in different property bank accounts to be pushed into this life insurance policy and cash flow of any of the property account? And if the cash flow of any property accounts drop, it could pull from the IBC account to pay the difference needed in the mortgage. Absolutely. That could be difference in your mortgage. That could be, I'll tell you what, y'all, if y'all want somebody to mess up your water heater, let me buy the property. Because if you need to replace a water heater, or you need a deductible paid for your, whatever your property needs, you can use the cash value to fund that right into that property specifically. Absolutely. You can do that. So Prasad, you've got it. Bear with me.
Yeah, so I got a direct question here. That is, if you open one of these policies, how long do you have to fund it, and how many years, or is it for life? So there are three separate questions, but
Yeah,
the first one is really how long once you open it do you have to fund it?
Yep.
Yeah,
It's,
good
I
question.
will say that's, again, one of the questions that we get. You can structure this to pay as much in as you want for as long or as short as you want, right? So again, you can dictate the terms of how this thing is structured. But what you will find and what you will want to do is put as much money into the policy over time. And here's what I mean by that. If you have an account that if you put, let's say $20,000 into it, at the end of the year, you put in 20 and you have 40, are you going to want to stop putting into that? No way. So again, and that's kind of where it comes to where David and I are going to structure and design and teach, like, all right, how do we get to that point? But that's a good question. Do you have to fund this forever? Absolutely not. Are you going to want to? Yes. I know David and I have one person who started off with a relatively small policy, and within 2 years, this same person now has 3 policies. He started one, maxed it out, did another one, maxed it out, and got one on his wife. Because the more you use this, the more you will use it.
Yeah, and then to answer your question on the first year, or the first, like, how long do you have to fund it? Usually you have that first calendar year to fund it. You could set up kind of a monthly payment, and then but within that calendar year, you have that whole year to kind of get that full amount put in. There is some other aspects on once you fund that first year, you do have some more leeway on if you miss all of years 2 contributions, you might be able to backfill, year 3, you might be able to backfill year 2. There's some other flexibility to that. We can get in more specific, but yeah, you have all calendar year to get that additional cash in. That base premium can be set as an annual, monthly, quarterly, semi-annual kind of contribution for that, but that additional money can be put in all calendar year in any increments.
Yeah, so Eric, you mentioned that one of your clients started out with 1 policy and then now is in 3. So even with the paid up amounts that you can do, at some point you reach a limit and then you would have to go into a new policy. Is that what the reason is for that?
Yeah. The first reason, is this first policy, he was able to do more, but he just kind of wanted to tiptoe in, right? Let me test the waters and see how this whole kind of administratively works, and does it work like they say? And it did. And he's a commercial broker, and so he was kind of putting in some of other deals and doing some things. He saw that it worked well. He wanted to start another policy. He started another policy that was a little bit more on par with where he was at financially. And then, after that, he's like, man, I've maxed this out fully. I'm looking at my deals coming up ahead. I've got a lot more liquidity coming in, and it's more than what I can put into both of these. So I want to set up another one. So yeah, kind of on that first one was just kind of a tiptoe in, but those other getting that third one was kind of the limitations of the first 2 and setting it up.
Very good. I think that also there was Cornelius Hyacinth asked a question, and that kind of is a good follow-up question to what you just answered. What is the minimum amount you can start a policy with?
Yeah, so you can do some, you could do a couple hundred a month if you want to. Now, I will say, to really get some benefit out of it, the minimum that you should really do to get kind of anything rolling out of it, I would say would probably be total base and premium would be maybe 10,000 a year. Now, we've had some younger guys that have started with term and then they've converted it, or they've started lower. So if you're early 20s, and you're young, I mean, that doesn't matter. You can always grow on that. We put ways to grow that, but it depends on your financial situation. But when it really shines when you can at least get, at least 10,000 total into the policy, so that it can start earning, so you can get 6,000-7,000 in right away to start compounding it. But there's really no. I think the minimum is based on like the death benefit, and you can get like $100,000 death benefit, which makes it super cheap. So it could be,
depending on age and health and all of that, which is actually a really good segue into Harita's question. So asking about like, what are the admin costs? So that kind of comes back, all the costs of the policy are baked into that first year. So it's really going to depend on each individual person. But to David's point, your your cost is going to be up to you. However much you want to put into that policy is going to be up to you. Meaning, if you want a really big death benefit, you want a whole lot, well, guess what? That's going to cost more than a low death benefit. And I've had, I don't know how many different people bring up, well, I might be too old for this. Well, hang on a minute, because again, we're not focused on the death benefit here. If you were to look at your 50-year-old self and your 30-year-old self, if you, right, are 30 years old and you put in the same amount of money as a 50-year-old, that's possible. The difference is that your 50-year-old self is going to have a lower death benefit than your 30-year-old self. So again, that cost and however much you want to factor in as your death benefit, that's completely up to you, but it's all going to be baked into the upfront of the policy.
Here's one other point too, because we tend to think, man, cost. That's all we think about, right? I think when you fully understand it, that cost will go out the window. Because let's say year 10 of the policy, okay, and if our minimum is 50,000 and we're putting in 50 and it's growing by 100, would we want our minimum to be 10 and growing to 20, right? Growing another 10? Or would we want maybe 100 growing to 200, right? If we knew the growth of that policy, and that's another reason that brokers, we really start to understand it when it's growing like that, it's almost like you kick yourself and be like, man, I'm putting in 50 and at the end of the year, it grew by 50. So now there's 100. God, I wish I would have done 75 or 100, right? So when you actually see that really, kind of has that paradigm shift. But then there is a balance of, because we've had to talk some people off the ledge too, like, whoa, Nelly, hold up, let's back it down a little bit. I know you're excited, but we need to look at really what's coming in. So there is that kind of balance of your finite budget, but also understanding how it actually works. So we're going to want to keep funding into this when you really understand how it works. Like, I know it sounds so cheesy, but I get excited and I look forward to, when is my next policy anniversary date? Because my bank liquidity is too high. Inflation is rampant. There's not a whole lot of opportunities right now. There's a few, but there's not a whole lot. So I'm like, man, I want to get them into the policy so that I know, especially the one that's like 12 years old, because I know the kind of earnings that it's doing. So again, it's a paradigm shift.
Did we answer Frank's question on the annual return of the policy? I don't know that we did that one just yet.
No, we have not.
Okay. So each policy is going to be a little bit different. There's going to be a guaranteed, right? Like we talked about, you have that guaranteed cash value that's guaranteed to grow plus a dividend. Companies are going to vary, right? Some have a lower guarantee with a higher dividend. Others have a higher guarantee with a lower dividend. So at the end of the day, we really want to remove our focus on IBC away from rate of return, because I'll tell hear me now, if you're putting your money into an IBC policy to get a rate of return, you're doing it wrong. Okay, yeah, that's not.
I promise you 20 minutes of showing you how this works and rate of return goes out the window. I promise you 20 minutes. I could even get a napkin in front of you with 20 minutes and I can demonstrate some things and show you how rate of return is not something we would think about. But to that point, there is guaranteed and dividends. So they're going to be earning more than a bank. You're going to be keeping up with inflation usually. I mean, hyperinflation is one thing, but again, 20 minutes of going through actually how this cash flow system works, and you won't care what the rate of return is in the policy.
But Frank, to tell you, like, from the root of it, like what is it based on? It's all based off of the company, their internal guarantees and the profits. So the reason I bring that up is these major A-rated companies are not investing in like speculative stuff, right? Like they're investing in laddered treasury bonds. They actually buy real estate, right? So they purchase multifamily. But the point is they're all based off of secure actuarial science. They're not using speculative investments. They're using statistics and time and large pools of people to be able to actuarially calculate how much is coming in, how much is coming out, and using all these various investments to grow their wealth along the way. Because the one thing to remember about a life insurance company that they have an advantage over us is they are mortal. They don't have a timeline, right? So they never have to sell out of an investment. They never have to cash out. They can weather that storm and ride it out if something like that were to happen.
Yeah, so they have some derivatives. They do some derivatives. I'm a big derivatives trader, right? Straddles. There's way to, iron condors, right? There's ways to kind of create some income on a leveraged side, right? They have some of that. They have bond ladders that they do. Some insurance companies are actually lending in multifamily, right? And how does the lender go wrong in multifamily? Worst case, you take over the property and take it to the market, right? I mean, so there's some aspects on that, but mostly around the actuarial science. But again, I don't even care what my dividend was each year. I don't even pay attention to that. I just know the way the compounded growth in the policy works, and I put it to work. So again, it's hard to not think about cost and rate of return. We're so baked and embedded to look at what's it cost me and what's my rate of return, but it's a real paradigm shift that has to happen when you fully understand the strategy. So the next one here is that I've researched whole life. Their admin costs are front loaded. What are your admin costs? Did we answer?
We did that one.
Okay, so which one are we on?
I think we only missed Kathy. So we haven't answered Kathy's question, which is asking about, is there ever negative arbitrage when taking a loan, like where the dividend paid is less than the loan interest? And do policy loans have an impact on dividend payouts?
Yeah, so policy loans do not. If you're using a non-direct recognized loan, that's the whole point of it. It does not affect the dividend payouts. You might get, I think I've seen one maybe a couple times. It was only because the loan rate might have jumped up due to an interest rate increase, and the dividend was a lagging factor on that. So, but it's
short-lived.
It's short-lived. Usually you're going to get at least the growth, the policy growth is at least going to cover the cost of the loan, at least. Most of the time you're going to start to see a slight arbitrage, and especially because that cash value after years and years, 5, 6, 7, 8, 10 years, that compounding growth is just outweighing any cost of the loan because that ability to continue to compound. But good question.
Oh yeah. Lots of good questions. Y'all are awesome.
Yeah, all great questions. I don't see any more questions. One question I have from my end is, when it comes to borrowing from related entities, you have to do arm's length borrowing from an interest perspective, right? So when we borrowed from a related entity, naturally we want to borrow at 20% and deduct that, but IRS doesn't allow that. So is there a similar structure with these policy loans where you have a limit on where the maximum borrowing interest rate can be?
Okay, so let me just try to clarify that question. Are you asking, when you borrow from the policy, is there any limits on the max interest
on the interest rate? That's right, because you are able to deduct that interest rate, right, from your taxes, right?
Yes.
And
exactly. Yeah, and there's not going to be a limit on it because it's usually low. The interest rates on those are simple annual interest, so there's not going to be a heavy volume of interest, and they usually range from like, the ones we use are like 4 to 5% simple. So yeah, there's no limit. So if you have $1 million loan or a $2 million loan or $100,000 loan, there's no limit on that. It's whatever that interest is charged can be. If it's being used for real estate, again, I'm not your tax advisor, but if it is a tax deductible, if it's able to be tax deductible on what you're investing in, there's no limit on it.
It's kind of like, we always talk about the interest you pay on your mortgage or interest you pay on, stuff like that. It's considered to be a business expense.
Mm-hmm.
Yeah, really good question. Good. I did put our emails in the chat in case you didn't get them on the.
And if I like to point out Tom Wheelwright, if you guys know of Tom Wheelwright, he's an awesome CPA guy, awesome accountant guy, super wealth of knowledge. I've had some good conversations with him. He's very much an advocate for infinite banking, and he's got some really interesting insight on some tax stuff. So we know enough, but we're not tax advisors, but we definitely know enough. We know the possibilities, but Tom Wheelwright is a good person if you guys kind of know him or have connection to contact him and kind of ask him about some of the infinite banking, how it might relate to your business. I think it'll put a new perspective on some of the tax piece on it.
Sounds great. So Erica and David, thanks again for your presentation and coming on tonight and answering all these questions. So as always, doing these virtual meetups, we going into a breakup room. We break up, I think we have around 30 people left, so we probably break up into 5 or 6 rooms or so. And if you still want to hang around, Eric and David, you're welcome. But if you want to drop off, that's obviously fine too. But we certainly appreciate you guys doing that presentation and answering all the questions. Thank you very much.
Thank you guys for having us.
For having us.
Yeah.
Thank you, David. Thank you, Erica.
Thank you guys.
Thank you.
All right, so we go into a couple of breakout rooms. So let me do that quickly. All right, guys, thanks again for coming on today. And thanks again, Erica and David, for your presentation and sticking with us also in the breakout rooms and answering all the questions. That was absolutely great. And so for those of you who are still on, we have that virtual meetup once per month. So we look forward to see you again at the next one. Thanks again, everyone, for joining. If you still want to hang out, that's fine. I have to log off, but if you guys still want to network, I'll leave the Zoom still open. Thanks again. Bye, guys.
Thanks, guys. Y'all have a good night.
Yeah.
By the way, Anton, one
Yes.
quick thing.
Sure.
Last meetup that you had,
Yeah.
you said you had to go. You stayed for 1 hour and 20 minutes answering everybody's questions. And there is a recording of this.
Okay.
Please, anybody who's interested, go and watch it. I watched it 3 times and I was on that Zoom call. It's the most interesting thing ever. Anton is the man. I met you in Houston at the Disrupt Equity event. You're like the coolest, most humble guy ever and the most knowledgeable person. So I just
Yes.
want to thank you for all you do. An
Oh.
hour and a half after you had to log off.
Yeah,
Yeah.
he's a liar too then, huh? You said you had to go, but you stayed. Anyway.
You did
Yeah.
stay.
Yeah, thanks for your comments, lad. Really appreciate it. And Renato, nice to see you there. Are you
Nice to see you as well.
are you coming to Atlanta?
No, David is going, but I'm not. I'm staying back in Orlando. We have a hurricane coming, so.
Okay, so you need to buckle down.
Yeah.
Yeah. All right, guys. So thanks again, and Vlad, maybe we see you each other in person at the next Disrupt event in Houston in February.
Yeah, I'll definitely be on that one.
Yeah, sounds good. Okay, bye,
Nice
guys.
to meet everybody.
Thank you.
Bye, everyone.